Welcome to Breaking News to Trading Moves.
Today's discussion is looking at recent retail financial reports.
Exactly. We're going to break down a specific headline and outline exactly which companies stand to win and lose based on the data.
Right. And for you, the listener, trying to understand the current retail landscape, we have a very precise starting point.
We do. Kroger, ticker KR, recently provided a softer 2026 outlook than the market wanted,
Yeah, so we are going to examine the strategy the new CEO is deploying.
which involves betting on growth by keeping prices down.
To really understand the actual market mechanics at play here, we need to look strictly at the numbers management provided.
Right.
Kroger, ticker KR, guided for identical sales growth of 1% to 2%.
Let's actually pause there for a second. We should clarify what that means. Identical sales growth is a metric measuring revenue generated strictly from stores that have been open for at least a year.
Exactly. It completely removes the revenue generated by newly opened locations.
Because if a company opens 50 new locations, top-line revenue naturally rises.
Yeah, but that masks what is happening at the core operational level.
Right. By isolating identical sales, you see the actual organic foot traffic and basket size.
And the midpoint of that 1% to 2% range sits below Wall Street expectations.
So that is the growth side. What about the earnings?
We have the adjusted earnings per share projected at $5.10 to $5.30.
Okay.
That EPS range is hovering right around or even below what analysts modeled.
So we have light organic growth combined with an earnings projection that falls short of a beat.
Exactly. Now, the strategy the new CEO is deploying to manage this is highly targeted.
They are betting on growth by keeping prices down.
Management's plan to win customers focuses on three exact pillars: keeping prices low, improving the quality of their fresh food offerings, and making delivery operations more efficient.
So they're intentionally choosing to suppress near-term profit expansion.
Yeah, to maintain their competitive position at the shelf level.
Which brings us to why this specific setup matters for the broader retail environment. Kroger operates as a primary indicator for the United States consumer.
It really does. The data flowing from their checkout aisles gives a highly accurate reading on the financial health of lower and middle income households.
For you analyzing the market, it is a barometer you absolutely have to monitor.
Definitely. When a major grocer of this size states plainly that shoppers are highly careful and that the company needs to reinvest internal savings directly into lowering prices at the register, it delivers a clear message about the broader economy.
But the core message is not that consumer demand is collapsing.
No, not at all. We are not seeing a complete halt in spending.
The data indicates the consumer is extremely precise with their capital.
Right. Market share gains right now cannot rely on an industry-wide spending boom.
Exactly. Winning market share requires tactical execution. Retailers must utilize sharper pricing, provide better service, and deploy highly efficient fulfillment operations.
Growth has to be taken directly from competitors through superior execution.
You cannot rely on a rising tide of consumer spending to lift all companies equally.
And this environment creates three factual takeaways based entirely on the data.
Let's go through them.
Number one is that value is winning. Number two is widespread margin pressure. And number three is a distinct retail split.
Let's look at the first one. Kroger's aggressive pricing stance forces a direct reaction across the sector.
It does. When a market leader decides to hold prices down, it dictates the terms of engagement for everyone else.
If Kroger feels it must stay aggressive on pricing to maintain foot traffic, other grocery chains and discount-oriented retailers have no choice but to stay competitive on their own pricing.
Right. They cannot risk alienating a careful consumer base by appearing more expensive than a primary competitor.
And that reaction leads directly into the second takeaway: widespread margin pressure.
The mechanics of margin pressure are very straightforward in the grocery business.
Because grocery already runs on notoriously thin profit margins.
Exactly. We are talking about pennies on the dollar. When you implement lower prices, you might successfully drive store traffic.
You might even increase the physical size of a shopper's basket.
However, those lower prices mathematically limit your profit expansion.
If the entire retail sector is forced to promote their goods harder and offer more discounts just to maintain their sales volume, the profit margin on each individual item sold is inherently reduced.
You are trading margin for volume.
Which sets up our third takeaway: a retail split.
We are seeing a distinct divide occurring within the industry.
And it is based entirely on how these companies are mechanically structured.
Right. This split separates the sector into two distinct camps.
On one side, Companies with strong scale, advanced logistics, and a clearly defined value positioning stand to benefit.
And on the exact opposite side, businesses with weak pricing power or a high exposure to branded markups are going to feel intense pressure.
So let's examine the winners based on this data, starting with the value-focused retail leaders.
The primary companies to look at here are Walmart, ticker WMT, and Costco, ticker COST.
Kroger's soft outlook firmly highlights that shoppers remain highly price conscious.
And this consumer behavior heavily favors large-scale retailers. Walmart, ticker WMT, and Costco, ticker COST, possess the strongest value reputation in the market.
More importantly, they have massive supply chain leverage.
Walmart's advantage here makes complete mechanical sense.
They use their sheer operational volume to dictate terms to their suppliers.
Yeah, when you operate thousands of massive supercenters, you can approach a supplier and demand wholesale pricing that a regional supermarket simply cannot access.
That scale gives them the mechanical ability to absorb pricing pressure far better than smaller rivals.
They can continue utilizing their price leadership to capture wallet share from competitors.
They can afford to operate on thinner item-level margins because their massive volume of sales compensates for it entirely.
But then you have Costco, which benefits from a totally different angle of that exact same price-conscious behavior.
Right. They aren't just squeezing suppliers. They operate on a model built entirely around bulk buying and membership fees.
The mechanics of Costco, ticker COST, rely heavily on perceived long-term value.
If consumers feel stretched by inflation, they often trade into bulk purchasing.
They recognize that paying a higher upfront cost for a bulk item, say a massive package of paper towels, yields a much lower unit cost over a 6-month period.
In a retail environment defined by careful budgeting, that perceived value drives steady membership renewals and consistent foot traffic.
So if massive scale is one way to survive this pricing pressure, another method is optimizing the most expensive part of the modern grocery business.
Getting the food to the customer's front door.
Exactly. That brings us to the e-commerce and delivery platforms.
We are looking at Maple Bear, which operates as Instacart, ticker CART, DoorDash, ticker DAASH, and Uber, ticker UBER.
The data point driving this is Kroger's stated goal of making delivery more efficient.
Reuters noted that Kroger utilizes a hybrid model.
This model specifically relies on delivery partners such as Instacart, DoorDash, and Uber Eats.
For you analyzing the operational side of retail, the concept of the hybrid model is crucial.
It really is. Grocery chains are leaning heavily into digital fulfillment to meet customer demand for convenience.
But at the exact same time, they are trying desperately to control last-mile delivery costs.
Last-mile delivery is notoriously expensive. Think about the pure capital expenditure required to do it internally.
A grocery chain would need to purchase a fleet of refrigerated vehicles.
They would need to build proprietary routing software.
They would need to handle driver compensation, insurance, and maintenance.
Grocers are actively trying to avoid that massive infrastructure build-out.
Therefore, the platforms that enable that ecosystem see stronger demand.
Instacart, ticker CART, DoorDash, ticker DASH, and Uber, ticker UBER, offer existing scaled logistics networks.
Grocery chains use these third-party platforms to stay competitive on speed and convenience without taking on the infrastructural burden themselves.
It allows the grocery chains to offer the service the consumer demands while outsourcing the mechanical challenges of the last mile to companies designed entirely around solving that logistical problem.
The grocer turns a massive fixed cost into a variable cost.
Exactly. They only pay the delivery partner when a customer actually places an order.
That is a brilliant way to protect margins.
Now let's look at the third category of winners, discount and budget-sensitive consumer plays.
The companies to focus on here are Dollar General, ticker DG, and Dollar Tree, ticker DLTR.
The tone of Kroger's guidance suggests that budget-conscious customers are making highly careful choices.
This economic backdrop provides a structural advantage for discount retailers.
Dollar General, ticker DGG, and Dollar Tree, ticker DLTR, cater directly to stretched consumers.
The data shows these consumers are actively looking for lower ticket sizes.
They need basic consumables at the absolute cheapest possible out-of-pocket price points.
This is entirely different from the Costco consumer we just discussed.
Completely different. When a household budget is tight and cash flow is strictly limited, a shopper might not have $60 in their checking account to buy bulk items.
Even if the unit economics at Costco are mathematically superior.
Instead, they require the ability to spend exactly $5 to get the basic essentials needed to survive until their next paycheck.
Breaking down the package sizes allows these stretched consumers to manage their immediate cash flow.
If grocery inflation is not subsiding enough to revive broad spending confidence across the economy, consumer foot traffic will naturally continue to skew toward these value-first chains.
Dollar General also places its stores in highly convenient rural locations where the nearest large-scale supermarket might be a long drive away.
Adding a geographic advantage to their low-ticket model.
Now we need to contrast those winners by examining the losers in this current retail setup.
The data outlines specific types of businesses that face severe headwinds.
First, we must look at traditional grocery chains facing this exact value war. This directly involves Kroger, ticker KR, and Albertsons, ticker ACI.
Kroger is the direct loser from its own cautious guidance.
When they state they must stay aggressive on pricing to protect and grow their market share, it serves as an admission that the broader grocery market remains highly promotional and ruthlessly competitive.
And if the market is that competitive, expanding profit margins becomes an incredibly difficult task for any traditional supermarket.
Traditional supermarkets face severe hurdles in a promotional environment unless they possess specific structural advantages.
If a chain does not have clearly better scale than Walmart or stronger private label economics, their margins will compress as they are forced to lower prices at the register.
We mentioned Albertsons, ticker ACII, in this category as well.
Even without issuing their own identical guidance, they face intense pressure.
The market isn't known for its nuance. If Kroger sneezes, investors assume Albertsons is already in bed with the flu.
That is referred to as sympathy pressure.
The stock market operates by categorizing companies with similar operational models.
Because investors assume the exact same industry forces applying to Kroger also apply to Albertsons, ticker ACI, their valuation faces the same downward pressure.
The market anticipates that Albertsons will also have to sacrifice margin to remain competitive on pricing because they share the exact same careful consumer base.
The next group of losers in this environment are the branded packaged food companies sold through these exact supermarkets.
Based on the data, we are focusing on General Mills, ticker GIS, and Campbell's, ticker CPB.
The pressure on these companies is generated by the supermarkets themselves.
When a grocery retailer decides to focus more heavily on affordability, promotions, and value for the consumer, they turn to their suppliers to help fund that strategy.
Branded food suppliers rapidly come under pressure.
Supermarkets begin pushing hard for lower wholesale pricing.
They demand more promotional support from the manufacturers, essentially asking the brands to pay for the discounts offered at the register.
Furthermore, the supermarkets place far greater shelf emphasis on their own private label products.
A supermarket makes a higher profit margin selling its own store brand items than it does selling a name brand equivalent.
The private label has no national marketing budget, no expensive television commercials to fund, and the grocer controls the manufacturing or white labeling costs directly.
It is a battle for physical real estate.
If Kroger wants to protect its margins while keeping prices low, they will place their own store brand items at eye level on the shelf.
The premium name brands get moved to less visible locations.
So when careful consumers are already actively trading down to save money, this dynamic severely squeezes the branded suppliers.
Companies like General Mills, ticker GIS, and Campbell's, ticker CPB, see their sales volumes drop.
Their profit margins compress.
And their overall pricing power deteriorates in the face of aggressive private label promotion.
It creates a highly restrictive environment for any supplier that relies on a premium brand markup.
If the end consumer refuses to pay the premium at the register and the grocery store refuses to stock the premium prominently on the shelf, the branded supplier loses on all fronts.
The final group of losers identified in the data are mid-market general merchandise retailers who are highly exposed to a cautious consumer.
The specific companies highlighted are Target, ticker TGT, and Kohl's, ticker KSS.
Kroger's outlook adds concrete evidence to the reality that households are strictly prioritizing essentials and bargains.
They're buying the food they need to survive and actively avoiding purchases they do not strictly require.
That creates a much tougher setup for retailers that require consumers to spend more freely.
Companies like Target, ticker TGT, and Kohl's, ticker KSS, rely heavily on discretionary spending and mixed baskets.
Let's break down the mechanics of a mixed basket.
The business model works best when a consumer walks in to buy essential groceries, which are often sold at a low margin to drive foot traffic.
But then that same shopper wanders into the apparel section and purchases higher margin items like clothing, home decor, or electronics.
Target makes the real money on the discretionary items, not the milk.
However, If food and everyday value remain the absolute strict focus of the household budget, companies with less defensive product mixes struggle.
If the consumer buys the essential groceries and walks directly out the door without looking at the apparel, the operating model breaks down.
They cannot attract the same steady demand because their inventory is heavily weighted toward discretionary items the consumer is currently choosing to ignore.
Kohl's is in an even tougher position, as they lack a robust grocery department to drive that initial foot traffic in the first place.
To summarize the factual takeaways from today's analysis, the data shows the consumer is highly careful, value is reigning supreme across the sector, and the retail industry is actively splitting based entirely on which companies have the structural mechanics to absorb lower prices.
The dividing line is remarkably clear. If a company possesses scale, robust logistics, and a value-first positioning, they can navigate a low-margin, high-promotion environment.
If a company relies on broad discretionary spending, branded markups, or lacks the leverage to dictate supplier terms, they are facing a highly restrictive operating environment.
Exactly.
I want to leave you with a final thought to ponder based on the specific market dynamics we discussed. If major retailers are aggressively training careful consumers to prioritize basic affordability and private label store brands over everything else, will traditional brand loyalty ever fully recover, or are household name brands permanently losing their premium status? This is not financial advice or buy or sell recommendations. This is purely the opinion of the author.